So Trump announced a 50-year mortgage. Whether that happens or not is a different story. Now, with that being said, what is it? We're going to go over the good, the bad, the ugly, and what it actually looks like on a monthly payment, specifically in my area, in Sacramento, California area. Might as well just talk about it. Let's get it all figured out. So first off, what the heck is it? It's a 50-year mortgage. Obviously, this is still a fixed rate term. I get in a lot of comments on like TikTok and Instagram. Oh, we don't want to do interest only. We don't want to do negative amortization. It's not either one of those. It's a fixed rate, regular amortizing loan. It is not interest only, and it will just add 20 years to the loan. So drawbacks of that, probably higher interest rate, and it's going to take a long time to pay off. So you're paying a lot less principal up front because the way an amortization schedule works. That being said, still a fixed rate mortgage, adds 20 years to the payment, designed for affordability, not saving interest, to clarify. It's not cheaper. It'll probably be used in some states, mostly high cost states, to do two things. Number one, help more people afford to buy a home. It's going to be able to actually up the qualification of where you qualify, or two, make the qualification of the kind of home you're currently looking at more friendly to your budget. So there's kind of two different ways to think about it. Now, obviously, this is not standard for Fannie and Freddie as of right now, but it's going to be used by probably some portfolio, possibly even FHA, and some non-QM products. So that's the basics. What the heck is it? Number two, really 30 versus 50 year, what are the numbers? And we're going to run through that a little bit today. We're going to run these numbers at a $450,000 purchase price. We're doing 20% down just to keep it kosher straight across the board. We're going to run about the same interest rate, show you the savings. It'll show just the numbers of what you're actually paying in the amortization schedule, how much principal up front. So let's dive into that. Okay, so here we go. This is a 30-year fixed at a $450,000 house price. We're just going to look at it real quick. Down payment's 20% down. Interest rate, this is going to be based on the average interest rate. This is not necessarily your average, because your average is going to depend on your file. But national average, this does not include some people paying points or how much the brokerage is making, anything like that. This is just a base based on national numbers. So 6.38. And we're just going to run this starting in November. Insurance, 1,000, that's a little lower. We're going to do 1,200 because I'm in Sacramento and that's probably a little more realistic. And then taxes at a 450 price, really we need to be somewhere around 475-ish yearly. So, maybe a little bit more than that, but that should be pretty realistic. And then we're going to get rid of HOAs. No one likes HOAs, so let's just not pretend we're going to pay them. Now, with that being said, this is the basics. Obviously, this is not quotes. They never are. This is just an estimate of where things should be for you in your 30-year fixed mortgage. Realistically, total monthly payment around $2,742 out of $360,000 loan amount. That's pretty average to what I'm usually seeing. With that being said, this is what's called your amortization schedule. This is the big thing to keep an eye on. Amortization schedule. You see that as you first start on this loan, let's see if I can zoom in like this. Yeah, perfect. That works. You're paying way more in interest than you are in principal as you get started. The blue line is your interest you're paying. Green is principal. So you're paying way more in interest when you start. You're paying almost no principal at the beginning. This is how an amortization schedule works on every single mortgage that's 30-year fixed. The banks basically do this, and this is the reason mortgages are set up this way, because most people either refinance or sell. So if they don't set the interest in up front, they're actually losing a ton of money on these loans. So that's kind of the way it works. Now, whether you agree with that or not, it's a different story. But realistically, that's the way this is going to work. So you're paying all this interest up front. So by, halfway through your mortgage, yeah, you're paying total principal is $91,000, but you've paid almost $290 in interest. But as you get to the end of this, you're paying way and way less in interest to pay off your full amount. See, your monthly payment stays the same, but the equity you have grows. Now, this again, just to show you that December 2025, you're paying $330 in principal. It's going to go up every single month, just a little bit, and your interest is going to come down a little bit every single month. People don't understand this is how an amortization schedule works. So by the time you're 15 years in, 2040-ish, you're looking at paying $800 a month in principal, which is why it does so much for you. Also, side note, if you decide to pay extra and do it strictly towards principal on your mortgage, if you pay an extra $500 a month on your mortgage for the first 2 years, that's why it's going to do so much to build your principal, because you're basically paying almost nothing on it up front. So that is that. Now we have, too much. Now we're going to go up. We're going to look at, hey, what if we did the same thing, but instead of a 30-year loan, we're going to take this down and use a 50. Now, as you guys know, if you've watched this channel, I don't gatekeep. I don't believe in gatekeeping. I'm not keeping information away from you. Go check it out yourself. This is just on Mortgage News Daily. I don't love their website for when they're talking about rates, because they are paid for by the sponsors that they have. So they'll recommend rates. And if you click on anything, they will call you like crazy. But besides that, for basic information like a calculator, they're really good. Also, if you don't like their calculator, I have mine linked below. If you want to use my calculator or get connected with me to try to figure out any information, that's down. Lastly, if you like this channel and you think I'm giving good information, please hit that subscribe, like, and leave me a comment below. Just let me know what questions you have. I'd love to answer them. Back to this. 50-year mortgage. So again, we're doing the exact same scenario. So we're doing 450, 20% down. That's your loan amount. Rate, we're going to just leave it as what it is, just for information purposes. Just try to show you where things are at. Now, again, same with tax and insurance. This is just an apples to apples, even though these two loans won't actually be apples to apples, because one will probably be at a higher interest rate. But realistically, now we're sitting down here looking at the same chart. Look how much more interest you paying for how much longer, right? So you're really not gaining almost any equity in the house until you get way over here. This is 25 years and you've paid 50 in principal. That's it. $53,000 in 25 years. That's what you own. Now, obviously this does not take into account a couple different things. Number one, appreciation. Your home is probably going to appreciate, not depreciate, or stay the same. In 10, 20 years, most likely it'll be worth at least double, if not more than that, of what it's worth now. Take that into account. But just when you understand that, you're starting off paying $82 a month in principal. So keep that in mind. Again, this is not me for or against the 50-year loan. We're just breaking it down today and talking about what it is. So once you get to this point, you have to get into the why would anybody do this? And to really look at the math on this, I looked at those two side-by-side comparisons of the 30-year and the 50-year fixed rate. And realistically, the biggest difference between them is the monthly payment. The monthly payment range between those two is just under, it's like $280. So that's not crazy, but that's a decent chunk of money. Now, realistically, for most people, $300 less than a mortgage is pretty nice. So again, as I mentioned earlier, you kind of have two different terms to think about this. Number one, the people that want to qualify for a bit more, maybe their income is good, or what they're showing on paper doesn't show as good, and they want to qualify for a little bit more. They feel like they can afford it. Number two would be the people on the other end that are saying this home is the one that I want, but realistically it's just too much for my monthly budget. I want to have my monthly budget down. And so they actually want less of a monthly payment. This is when you'd use that. Now, realistically, the rate's probably going to be higher. So the monthly payment we're seeing here probably is inflated a little bit. Most likely we'll actually see around $200 a month at this price. With that being said, again, who would do this? Number one, the lower mortgage payment. Number two, it helps qualify buyers for higher purchase price. It's also just a little bit more flexibility for the budget, and it could be a temporary tool. This is the biggest one that I'm blown away by the people on TikTok that the responses they're giving to this is, why would you ever do this? I can't imagine doing this. This, just like down payment assistance, which I also preach about here all the time, could be a great tool to get into a home that you then refinance out of later. Again, this is not a mortgage that makes sense for you to hold for all 50 years. Absolutely not. This is a mortgage that you use to get into the home for a lower price. And then once rates come down, you refi into a 30, a 20, a 10, whatever you can afford at that time. It's also assuming a good conversation happened with a lot of people. Mortgages are interesting because the mortgage stays the same minus taxes and insurance. That's going to change, but the mortgage in and of itself will stay the same. So if you're in a job where you're going to make more income, if you're in any sort of union, if you're in anything where you are in sales, where you expect your sales to be higher, every year your income should be going up. If your income is going up, really what you should be doing is either paying down more of your mortgage, paying off other debts or things like that, depending on what you want to do with your finances. Or if you can afford to refinance into a lower term, if paying off a home is a goal for you, then refinance to a lower term. You have the income as the income goes up to hopefully do that, to actually shorten your loan instead of elongate it. And especially if rates are down, which rates are always lower on the lower interest or the lower term loans anyway. You go to a 15-year and it's going to be 3/4 to a 4% lower than a 30-year fixed. That's the biggest thing. Now, obviously the downside is the long-term costs. You pay significantly more interest, not just up front, but over time, like way different. The total interest paid, is almost double. It's almost double the amount of interest. So instead of paying $450,000 in interest on a 30-year loan, you're paying over $800,000 interest. If you keep the loan the whole time. Most people won't. So, obviously you then build equity way slower because of that. So you're basing it, because you're paying almost no principal down, you're basing all your equity totally on appreciation. So if the appreciation goes up, you'll make money. You're not going to make much. And you're going to stay in debt longer. And it's just not ideal if you hold the full term. Now, realistically, I think let's get into the weeds a little bit on this. So sorry, this is going to be a long video. But I like to give people things to think about, especially if you're researching this. So if you've made it this far, thank you, first of all, for watching this far. Things to think about, especially for first-time home buyers who's probably going to be watching this video. When you sell a home, usually you pay your seller's agents. You also pay the buyer's agent. So on average, both sides charge 2.5% to 3% each. Most of the time, the sellers pay that, which is the benefit. When you're buying a home, you usually don't have to pay that out of pocket. It's just wrapped in and the sellers pay it for you. So most people take that in consideration when pricing their homes, is they're losing 6% to the sellers and the buyer's agent. A loan like this, if you don't refinance out of it and you don't actually make enough money on the equity if the appreciation does go up enough. Realistically, if the home appreciates, if you sell this in 5 years, let's see, 2025, 2030, right? So we're looking at November 2030. You've paid $5,000 off in principal. If this was a $450,000 home after 5 years, assuming, let's say, a 4% appreciation, we're going to do, just some simple math. We're looking 450 times 0.4. So about $20,000 a year. So let's say this thing appreciates over 5 years at, let's say you add $100,000 to the total appreciation. Now, when you're doing that, you've only paid off $5,000 in interest. So you've added 50 or 100,000 depreciation, you've added 5,000 in, an actual principal at that point in time. When you sell, you're paying 6% of that $100,000. So, you're at 550, 6% of 550, is going to be, 33 grand. So you're still walking away with some equity. You're still walking away with some cash, but realistically, you're losing quite a bit by doing a 50-year as opposed to what you'd be making if you were in a 30-year. So something to think about as you're looking at these longer loans is they really make sense for certain things. So big picture on all this is the 50-year mortgage is not the best strategy depending on your situation. So realistically, this is not a good long-term. You don't want 5 different 50-year mortgages. You don't want to have to refinance a mortgage, a 50-year mortgage into another 50-year mortgage. It just doesn't make sense. But with that being said, every single mortgage product, which is why we have so many mortgage products, some are interest only, some are bank statement only, some work on, DSCR properties. There's so many mortgage programs because every program has a client that needs that program. This is a good program for the people that need it. Now, realistically, you just need to make sure you understand the drawbacks, which if you've watched any of my videos is the point of everything I do. You always need to understand the drawbacks of every single mortgage product, whether it's down payment assistance, bank statement loans. You should know what you're getting into and why before you pull the trigger and sign the dotted line. Once you sign, you're in. That's a bummer. But realistically, if you know the risk and the reward, you just have to weigh them for your situation. And that's why you work with a loan officer that can actually help you figure out what are your goals. If your loan officer or your real estate agent are not asking you that, dump them right now because it's not worth your time. You need someone that understands what you want, what your goals are. Are you trying to build wealth? Are you trying to turn investment properties? Is this just your first home and you're saying, hey, anything I can get into, I'm going to be happy with. I can't afford it without this. I'm going to afford it. And then when I can, hopefully down the line, refinance. Understand the scenario. And that's what you need to work with is people that understand that are willing to fight for you and work with you there. It is a good door opener and it will help certain people get way better. But like all mortgage products, it has a time and a place. It is not every single mortgage. And I don't think, my personal prediction is that it will take over the 30-year fixed. I think the 30-year fixed will still be the bull in the market. And anything beyond that is just going to be above that. So that being said, 50-year mortgage is a tool. It's going to lower the payment. It's going to raise the long-term cost. But the real question is, do the monthly savings outweigh the drawbacks and help you get into a home sooner? Because if the answer is yes, getting into a home as soon as possible may be the best thing for you with the way real estate appreciates. That's my TED Talk. Thanks for listening today, and I will see you next time.